Stop scrolling. Right now, on-chain data is flashing one of the most counterintuitive signals in crypto history. It looks like XRP is disappearing. Over the last 18 months, billions of dollars worth of XRP have been pulled off centralized exchanges like Binance and Kraken. And I don't mean delisted. I mean removed by the owners. Usually, when a coin vanishes from exchanges, it's a terrifying sign. It means massive liquidation, a regulatory clampdown, or utter capitulation. But this is XRP, and the story here is the exact opposite of a crash. This migration is not a sell-off. It's a seismic shift that points to a future where XRP is no longer a speculative asset for retail traders, but a tightly controlled, high-value settlement tool for institutions. The XRP you own is still yours, but the way institutions, central banks, and major financial players are now treating the asset is fundamentally changing its market dynamics. Today, we break down where this XRP is going, why this is the most bullish news for the price, and the ultimate destination for XRP that no one saw coming. Chapter 1. The On-Chain Evidence. Where is the XRP going? Welcome back to the channel. Let's start with the cold, hard numbers. Data from major on-chain analytics platforms like Glassnode and CryptoQuant confirms that the XRP supply held on exchanges has hit a multi-year low. We're talking about a move of over 3 billion XRP out of the retail trading environment. To put that in perspective, that's more XRP than was moved during the entire post-SEC lawsuit delisting period. So, if they aren't selling, what is happening? There are two primary destinations for this vanishing supply, and they paint a picture of highly sophisticated institutional accumulation. First, self-custody and cold storage. A significant portion is moving into long-term, self-custodied wallets. This is the whale play. These aren't new retail investors. These are massive entities known as whales who've finished accumulating and are taking their tokens off the volatile public market. Second, utility contracts. And this is the part that signals the true paradigm shift. A substantial amount is being locked up in new utility and decentralized finance contracts on the SERPL. This is XRP being put to work. Think of it this way: exchange supply is selling pressure. Wallet supply is holding power. Contract supply is utility. The balance of power is shifting dramatically away from sellers and toward long-term utility holders. Chapter 2. Ripple's HODL and CBD narrative. The utility black hole. To understand the why, we have to look at Ripple Labs themselves. For years, the narrative was about being a cheap alternative to SWIFT. Now, they're focused on two much bigger, more influential industries: on-demand liquidity (HODL) and central bank digital currencies (CBSES). HODL uses XRP as a bridge currency for cross-border payments. A bank in Mexico needs US dollars. Instead of pre-funding an account, they convert pesos to XRP, instantly send the XRP, and the partner instantly converts the XRP to USD. This requires a large pool of XRP for liquidity. HODL uses XRP as a bridge currency for cross-border payments. A bank in Mexico needs US dollars. Instead of pre-funding an account, they convert pesos to XRP, instantly send the XRP, and the partner instantly converts the XRP to USD. This requires a large pool of XRP for liquidity. As more large financial institutions onboard to HODL, their XRP needs become massive. They don't buy small amounts on a retail exchange. They acquire institutional-sized blocks and then they take custody of it. This acquisition process is a massive vacuum, sucking up available supply and removing it from the tradable market. But the even bigger game changer is the CBD space. Ripple is positioning the SERPL as the backbone for multiple countries' central bank digital currencies. They've built the technical capability for these central banks to issue, manage, and settle their digital currencies using the SERPL's technology. When a central bank or a massive settlement institution holds XRP, that XRP is not going to an exchange. It is being vaulted for regulatory compliance and strategic reserve. We are watching the transition of XRP from a crypto asset to a global financial reserve tool. This leads us to the critical point. The shrinking supply on exchanges fundamentally changes the risk profile for large institutional players. Chapter 3. The Scarcity Shock. How supply squeeze impacts price. Here's the simple economics of why this vanishing act is so bullish. Scarcity. Think of it like this: if 50% of a stock's float is locked up by long-term strategic investors, the remaining 50% becomes hyper-volatile. Any significant demand creates an outsized price movement because there are fewer sellers willing to meet that demand. For XRP, the total circulating supply is roughly 55 billion. The on-chain data suggests a huge portion is now held off exchange. If only 10% of the remaining supply is liquid and actively trading, any major institutional purchase, say $500 million, will have an exponential impact on the price. This is the recipe for a classic supply squeeze. The catalyst for the squeeze won't be a random social media rumor, but a massive multi-million-dollar order from a bank or a new spot XRP ETF that requires a sudden, large accumulation. This is the new reality. The market liquidity for XRP is drying up for the public, which is exactly what the institutional players want. They want to buy in at a lower price before the liquidity truly vanishes, and they're forced to bid the price up dramatically on a major order. We are at the final stage of institutional accumulation. Once this exchange supply drops below a certain critical threshold, let's call it the liquidity cliff, the next major order will send XRP parabolic. We've seen this before with Bitcoin and Ethereum. As institutional interest grew, exchange balances plummeted. It's a direct correlation. It means the asset is maturing beyond its casino phase and into its infrastructure phase. The long-term impact? Lower volatility in the day-to-day, but an explosive, non-stop upward trajectory when the fundamental demand outstrips the incredibly thin remaining supply. Chapter 4: The Regulatory Clearance and ETF Catalyst. Of course, none of this institutional accumulation happens without the massive regulatory clarity Ripple has achieved. This is the foundation upon which the supply squeeze is being built. The court ruling that determined XRP itself is not a security on open exchanges was the starting pistol for this institutional race. It instantly cleared a path for major financial players who operate in a strictly regulated world to engage with the asset. The immediate effect? Ray listings. But the long-term effect is the ETF application queue. We have major asset managers, the same names behind the Bitcoin and Ethereum ETFs, lining up to offer a spot XRP ETF. An ETF is simply a mechanism for Wall Street to buy a huge amount of an asset and hold it on behalf of millions of clients. When an XRP ETF is approved, the issuer has to buy physical XRP to back every share they sell. This brings us back to our vanishing supply problem. An ETF approval could trigger a single order, a multi-billion-dollar order that completely wipes out the remaining liquid supply on every major exchange. There will be no one left to sell. This isn't theoretical. Look at Bitcoin's movement post-ETF approval. The institutional demand was unprecedented. For XRP, a successful ETF launch, combined with the already low exchange balance, could be the most explosive catalyst in crypto history. The fact that institutions are already accumulating before the ETF approval is all the confirmation you need. They are front-running the inevitable, quietly moving the assets to their custody wallets while the price is still relatively stable. Chapter 5: The Circle Ecosystem and the True Destination Beyond the Institutions. The Circle ecosystem itself is providing a massive gravitational pull for XRP. We're finally seeing true utility locking up tokens. Features like the upcoming sidechains and the growth of decentralized exchanges on the Circle mean that XRP is being used for far more than just remittances. It's the gas, the fee mechanism, and the foundational asset for a burgeoning DeFi ecosystem. Every time a developer builds a new service, they need a large liquidity pool for their token pairings. Every time a user interacts with a new dApp, they pay the network fee in XRP. This growing internal utility is another form of supply absorption, a slow, relentless leak out of the open market. The biggest factor here is the concept of burn. Every time an XRP transaction is executed, a tiny amount is destroyed. While the amount is minuscule, the velocity of transactions due to HODL and ecosystem growth means that the total number of XRP is slowly, irreversibly decreasing. So, we have three massive forces pulling XRP off exchanges: institutional HODL accumulation, ETF front-running, and Circle ecosystem utility. These forces combine to create the most bullish supply shock scenario in the top 10 cryptocurrencies. It's no longer about if XRP is going to have its price moment. It's about when the thin remaining exchange supply can no longer satisfy the massive institutional demand. And that time is very, very close. Chapter 6. The Long-Term Forecast. And your strategy. So, what does this all mean for your strategy? The on-chain data suggests retail investors should adjust their expectations. The days of 10% daily swings based on random tweets are likely ending. We are moving into a phase of controlled, mega-cap growth dictated by institutional demand. The vanishing supply strategy. For current holders, this is a strong argument for mirroring the whales, self-custody. Get your tokens off the exchange, secure them in a hardware wallet, and prepare for the long-term appreciation that comes when an asset becomes foundational infrastructure. For those looking to invest, understand that the door for cheap accumulation is closing fast. Every day, the liquid supply shrinks, making the inevitable price shock more powerful. The long-term forecast isn't about $5 or $10 anymore. When you look at the total addressable market of global cross-border payments, interbank settlements, and central bank systems, a fully adopted, supply-constrained XRP has a price ceiling that is orders of magnitude higher than anything we've seen. The vanishing act of XRP is the ultimate confirmation. The institutions are here, they are moving in silence, and they are changing the game forever. Let me know in the comments, are you taking your XRP off the exchanges? What is your personal price target when the liquid supply finally hits zero? If you learned something from this breakdown, please hit that like button, subscribe for more in-depth on-chain analysis, and check out my previous video on the future of the SERPL sidechains right here. Thanks for watching, and I'll see you in the next one.